What's up everybody, it's your boy Graham J, your mortgage point man for Mortgage Solutions. And this is a pilot to a very new series that I'm excited to start, and that's just informational content, digestible content, all through YouTube videos. And we're gonna post these in tandem with articles that we write on my website, grahamj.com. So I would love your support. Please like, subscribe, share, follow, whatever the heck you wanna do, and my support will come right back to you. So thanks again, and we're gonna dive into today's topic, which is buying a home with FHA financing after a bankruptcy in your life. This is a hot topic item because it comes up quite a bit. Most people that have a bankruptcy think that they're stuck for 7 years, they can't really do anything, and they're just in this limbo waiting to figure out when they can start financing things on better terms. So how I would like to do these videos is basically share with you an article that I wrote from my website. We'll go through it, I'll read it word for word, and after that I'll talk about the topic in detail. Either some situations I've been in, my conjecture, my logic, how I can help you get to the finish line, or how you can help yourself with your loan officer that you're working with get to the finish line as well. These are not impossible situations to overcome. They just require some work, some experience, and some knowledge on how to get to the finish line. Oftentimes underwriters just seem like they want to deny, but when there's a will, there's a way. So let's jump into it and let's read the article. I'm going to be reading this word for word, so you're going to see my eyes go up and read, and that's the whole point of this. I'm going to read the article and then we're going to dive into the topic. When you hear the B word, the general consensus is uncreditworthy. Quite often, the public views bankruptcies as a 7-year sentence, leaving a person ultimately uncreditworthy and unable to obtain new credit until their sentence is over. Well, I've got some news for you. You can actually buy a home with a bankruptcy on your record, and you don't have to wait 7 years to do so. In this article, we are going to focus on the seasoning requirements that need to be met in order to approve an FHA purchase of a home or an FHA loan post-bankruptcy. When we say seasoning, we are strictly talking about the time that has elapsed since the bankruptcy. When qualifying for an FHA loan after a bankruptcy, there are a few guidelines that must be followed, and they will vary based on the type of bankruptcy, Chapter 7 or Chapter 13. If you filed a Chapter 7 bankruptcy and you're looking to qualify for an FHA loan, you must first be discharged. All of the seasoning requirements for an FHA loan after a Chapter 7 bankruptcy will be calculated from the discharge date. The soonest you can apply for an FHA loan after a Chapter 7 bankruptcy is 1 year or 12 months, 365 days after the case was discharged from bankruptcy court. For example, if you were discharged on 8/20/2023, you could apply for an FHA mortgage no earlier than 8/21/2024. Now, although this shortened time period is available to you, it does come with an exception to the rules. This exception is the evidence of an extenuating circumstance surrounding the cause of bankruptcy. And by this, we don't mean that you had a bad year and you're back on your feet again. FHA underwriting wants to assure that this extenuating circumstance surrounding the bankruptcy was truly a one-time event that was brought upon an uncontrollable external force in your life. Since underwriting logic can vary, these loans are reviewed on a case-by-case basis. It's not appropriate to go into specific situations here, but just know that the reason better be good surrounding your bankruptcy and the extenuating circumstance that caused it. Now, let's say you clear this guideline and you've got the approval. Well, you'll have some compensating factors that you'll have to pass as well to meet the final underwriting guidelines. These can include residual income, reserves, payment shock or payment shock avoidance, and additional income that's not listed on the application. I'm going to go into detail what each compensating factor means. Residual income. This is income left over after your expenses each month. These are calculated through a special formula, and the amount needed will vary depending on family size and region of the country. Reserves. Liquid funds available in your bank account after you close your loan. You'll generally need a few months of mortgage payments left in the bank after closing to make this work. This guideline can change, so we won't give specific reserve requirements here, but generally speaking, 1 to 3 months is what we look for. Payment shock. Evidence that this new mortgage payment will not exceed your current rent or other housing expense by a certain threshold. As of right now, it's 200%. So if you have a current housing expense of $1,000, your mortgage payment shouldn't exceed $3,000 because that's over 200% more, and that would be considered payment shock. The next one is additional income. This would be any additional income in the household that's not listed on the mortgage application or used as effective income. For instance, say you've got a spouse, but she's not on the loan, but she's been working for about a year or year and a half, and she's got income, but we're not using it to qualify. We can use that as a compensating factor for the loan because we're in this heightened sensitivity of underwriting. Now with that out of the way, for anybody else trying to qualify with a Chapter 7 bankruptcy, the seasoning requirement is 2 years after the date of discharge. If you wait for the 2-year mark, you won't need to prove any extenuating circumstance, and the need for compensating factors will be greatly reduced. But no matter which route you take, you must demonstrate creditworthiness. If for some reason you don't, you may face more scrutiny in each situation than you'd like to deal with. So keep your credit clean after your bankruptcy discharge. All right, moving into Chapter 13 bankruptcy. Now, a Chapter 13 bankruptcy will have different requirements to fulfill in order to obtain FHA financing. Because Chapter 13 bankruptcies don't discharge until all payments have been made, the discharge seasoning requirements are different. Typically, the minimum wait time for FHA financing with a Chapter 13 bankruptcy is 12 months as well. However, you need to demonstrate 12 on-time payments with the court-ordered payment arrangement, as well as good credit habits and history after the Chapter 13 started. In addition to that, you'll need written permission from the court in order to obtain FHA financing. The same compensating factors will likely apply as well. However, the further along you are in your bankruptcy, the less likely they are to be a factor. So the aforementioned compensating factors may or may not be applicable here, but if they are, I'll repeat them once more, I'm not going to go into them, but it is residual income, reserves, payment shock, or additional income that's not being used to qualify. Now, once you've discharged your Chapter 13 bankruptcy and you've demonstrated responsible credit habits, none of the above may apply. Since Chapter 13 bankruptcies don't discharge until you've completed your payment arrangement, many buyers have had time to reestablish good credit and remove the need for compensating factors and limitations. In conclusion, this is one of the best types of loans out there for somebody trying to get back on their feet from hard times. Homeownership and equity appreciation is a phenomenal way to build wealth for individuals and families in America. So that's it with the article, and I'm sorry, my reading prompter, whatever, I'm just not good with it. But I want to dive into some of the more candid stuff here. So with an FHA manual underwrite, which is when you're buying a home with a bankruptcy that's fresh, it'll go into what's called a manual underwrite, and that's where you'll see the extenuating circumstance need, the compensating factors, and anything else that's involved with trying to get a loan like this through the door. So with that being said, I kind of want to share with you some tips and tricks that I have up my sleeve when it comes to approving something like this, and that is getting everything packaged ahead of time. And by this, I mean doing your due diligence as a buyer, as a loan officer, as a real estate professional. If somebody's got a bankruptcy in their recent past 1 to 2 years, make sure the loan officer understands that, they've had a chance to look at the credit, and they've gone through the underwriting process. Look, TBD underwritten approvals exist. That means you've gotten the underwriting done before you find a house. This was a very competitive way for people to operate back in 2021, and it still is a very good tactic, especially with somebody in this situation. The reason this is so important is because not one situation is like the other, especially surrounding a bankruptcy. So when you go into underwriting, if you've got a contract and you're waiting to close on a home and a lot of this stuff is being reviewed and you run into hurdles and obstacles, it's not going to be a fun time. So you really want to get all this done way ahead of the shopping process. Make sure you have the hurdles addressed, overcome, any conditions the underwriter wants to see figured out. There's just so much that you have to do while you're in underwriting, and especially with a bankruptcy, it's important to get it done ahead of time. So my best advice is, no matter what your situation is, just get it underwritten the first time. Go to 1 or 2 banks. I had one situation where we sent it to one bank, they said no, the other bank said they'll consider it, they're gonna send it to FHA and see what they think after we get all of the documentation together. These processes take time. And so with that being said, don't think that you're just out for the count if you've got this on your record. Get it prepped, get it looked at, have your loan officer go through everything, tell your real estate professional what's going on, get all of the dirty laundry out, and see if you can get the loan done, because I have seen people buy homes with bankruptcies. It is possible. You just got to do your homework. It is a little more work, but guess what? You put yourself in a situation that causes you to be a little more of a high risk, but it doesn't mean you're not eligible to buy a home. So always think about that. I hope this helps. I hope this was useful. Please like, subscribe, comment, share, do whatever you want. I don't care. This is Graham J, your mortgage point man, and I hope to continue to bring you elevated, exceptional content and information. Have a wonderful day.